All right. Well, good morning, everyone. And thank you, everybody, for being here this morning with us to listen to Craig Sheaf with Texas Security Bank give his presentation on building a healthy balance sheet. I want to introduce our Bold Speaker Series sponsor, Sean Cass with Texas Security Bank. Sean will also introduce our speaker. So just really quick, as Sean goes through his presentation and as Craig goes through his presentation, if you have any questions, please remember to use the chat feature. And then at the end of our presentation, we will translate those questions to Craig and he will answer all the questions. All right, Sean, let's give us presentation.
All right, good morning, everyone. I'm excited to be here today. As I've said before, I'm super excited to host this business speaker series along with the Garland Chamber of Commerce. This is something that we as a bank have done for many, many years and had the good fortune to partner with Andrea and the Chamber of Commerce to provide this content locally in this market. So I know many of you. Those that I don't know, I would love the opportunity to get to know you. And for those of you that I do know, welcome back, my friends. So I've got a great opportunity this morning to introduce Craig Sheaf. I've got to be very careful because although Craig is my friend, he's also my boss here at Texas Security Bank. So I'm going to keep it clean today. But Craig has over 30 years of experience serving middle market banking, including experience at Wells Fargo and Bank of Texas, where we met before founding Texas Security Bank. Texas Security Bank is one of the fastest growing, most profitable banks in the nation with about $1 billion in assets today. The bank operates with a single focused mission, and that is elevating the champions of free enterprise. TSB has been featured in Forbes, the Dallas Business Journal, and continues to have a 5-star Bauer financial rating. Craig has been featured in Fortune magazine, is president of Swiss Avenue Historical District, member of the Greater Dallas Assembly. He and I are both C12 members, and he's a Dallas Chief Executive Roundtable. So without any further ado, I am actually very excited today to introduce Craig Sheaf, founder, president, and CEO of Texas Security Bank. All right, my friend, take it away.
John, that was very sanitized. I appreciate it. Thank you, everybody, for joining us. I'm excited to provide a little bit of education about the balance sheet. And every business has a balance sheet. And can everybody see my? Okay, so why is balance sheet? I apologize for the difficulties. Should practice that. Why is balance sheet important? Go ahead. Okay, so as I was talking about, it provides a cushion for disruption. It also provides a cushion for opportunities. And what I was saying is one of the things that business owners have to realize anytime they go into business is they are assuming risk. And there's a fancy name for assuming risk, and that's called underwriting. And as a bank, we underwrite businesses all the time. Sometimes business owners don't look at things necessarily like bankers do, but we are underwriters. We assume risk at a cost. One of the things that we talk about with our customers and our bankers is that we assume risk that's both seen and unseen. And if you're a business owner, you know that certain things pop up that are unexpected. It could be a number of things. It could be the shutdown that we're in right now. Obviously, an economic downturn, loss of a customer, loss of an important vendor. Just if you're in a manufacturer, a disruption in the manufacturing process, a line goes down. And what that healthy balance sheet does, and the product of a healthy balance sheet is working capital, is it gives us that cushion in the event that something like that happens. It improves liquidity. Next, apologize. It improves debt capacity. As we'll see, we'll go through a case study here, and we'll see how that happens. In having additional debt capacity obviously provides additional cushion in the event something happens in the business. It also allows the management team to be more strategic and agile and gives them options from a strategic planning standpoint. A lot of times when you get into strategic planning, you know, one of the first questions that come up is, do we have the capacity to do it? Do we have the borrowing capacity? Do we have the human resource capacity? And building a healthy balance sheet allows you to take advantage of opportunities. All right. The other thing is, as we'll talk about, what's really interesting is that the faster the components of the business go, the healthier the balance sheet is. And the faster the components of the balance sheet go, that actually creates cash flow. And as you guys know, cash flow is the oxygen of business. All right. Okay, and as we'll see in the case study that we do, is it maximizes performance and profitability of the business. And as we'll see as well, the healthier the balance sheet is, when you go out and access capital, whether or not that's debt or that's equity, the healthier the balance sheet is, the lower the cost to you of outside capital. All right, so what does a healthy balance sheet look like? It considers quantitative and qualitative factors. And what I mean by that is every business is within some type of industry. And there's certain quantitative factors that you can look at and benchmark your organization against relative to your peers. Banks are famous for doing that. And we have access to all kinds of data to get an indication of what good, what healthy looks like. For a typical business, there are certain ratios that you look at from the balance sheet standpoint. That could be the leverage of the business, the working capital or current ratio position, receivable turn days, inventory turn days, accounts payable turn days. The benchmarking is just a reference point, but it's an important one. And when I share benchmarking data with companies and customers, a lot of times they'll just say, well, you know, our business is different. And without a doubt, it is different, but it's just a reference point. The other thing is qualitative factors, and we'll delve into that quite a bit. What are some of the qualitative factors? So the next. All right, next. Okay, so when we think of the balance sheet, and you look at a balance sheet, there's a lot of components to it. And each one of them is a snapshot in time. It is, think about it as a cell. When you think about the health of the human body, a lot of people talk about starting with good cell health, and it's the same thing with a balance sheet. So there you have the components of the balance sheet. We'll talk more about each one of those. Okay, next. All right, it optimizes working capital, and we're going to think about working capital maybe a little bit different than you've thought of working capital before. There's a traditional definition of working capital. It is the cushion in the balance sheet that protects us from these unforeseen things, and also gives us opportunity to take advantage of situations based on our strategic plan. It optimizes cash flow, as we'll see, and it optimizes liquidity. Those are really, really critical. If what you're trying to do is build an organization that's going to last for a long time, whether or not you're planning on succession planning or selling the business at some point, either one of those, whoever you hand the business off to, your kids, your partner, whatever, you want to leave it in the best state possible. If you're looking at selling your business at some time, you want to optimize the value of that business when you do. And so there's certain things that are really important in order to do that, and creating a healthy balance sheet is one of them. All right? All right, so we're going to talk about properly structured too. There are things that we'll talk about that businesses do sometime that really can have a negative effect on that working capital cushion that we've talked about. Okay. All right, so cash consideration. Okay, remember that excess cash costs money. One of the things that we encourage our business owners to do is to automate your line of credit such that as excess cash flow comes in, it's automatically swept against your line of credit. It maximizes the availability on the line of credit. It reduces your cost of banking. A couple other things that I wanted to just mention regarding the qualitative factor of cash. These are questions from a banker's perspective that when I look at somebody's balance sheet, I may ask them these type of questions. All right, one qualitative item is, do we have cash in excess of the FDIC limit? Okay, may not seem to be a critical thing, but it's always something that you ought to look at. If you've got $1 million in your checking account, it's probably worth, we have products at our bank, for example, that even on $1 million, we can get you full FDIC insurance. The other thing is if you do have cash in excess of the FDIC limit, it's probably worth inquiring. Sean mentioned bank ratings, understanding what the rating of your bank is. Okay. Do we have good audit controls on cash and clear documented process of separation and duties to deter fraud? So when you look at cash on somebody's balance sheet, you probably don't think about those things, but those are qualitative factors on that particular component of the balance sheet that affects the overall health of the balance sheet. Do we have dual authentication on wires in ACH in the business? When I look at somebody's cash balances, that's the type of question that comes to mind. That's one of the most obviously important components of the balance sheet, and you want to make sure it's protected. What are our technology policies and procedures and monitoring to minimize threats, cyber threats like phishing and ransomware? That is a threat to the cash balance on somebody's balance sheet. So that's definitely something to think about. What is the term on the line of credit? So when I think about liquidity, I think about availability on the line of credit, and I think about cash balances. That's the liquidity in that business. And so a business that has a 2-year line of credit versus a 1-year line of credit is a little bit better. And so that's something to think about. That line of credit oftentimes has covenants with it, like profitability covenants, maybe a leverage covenant, maybe a borrowing base. And I also like to know what type of margin there is between their covenant and where they sit today. If somebody's right up against their covenant and we're depending on that for liquidity and they have one bad month and that availability on the line of credit goes away, then that's something that affects the quality of that particular balance sheet component. Do we have a good working relationship with our banker and our banker's superiors? Again, that's a qualitative factor on that particular component of the balance sheet. So just something to think about as we look at each of these components. Okay, the next. All right, so this, I'm going to ask you to go ahead and play that. And this is a pit stop in 1981 versus 2019. Before you play it, I want you guys to think of all your processes in your organization, whether it's your collection process, your purchasing process, your onboarding process, and there's just a ton of processes throughout every organization. I know it's that case at the bank. And we're always looking for ways to make that faster and more efficient, because what it creates is enormous amount of capacity within the organization to be able to handle more business with the same amount of people. And it also speeds up a business's cash collection cycle that over time improves the balance sheet faster. So it's just a mindset. So go ahead and play that. And it's pretty astonishing, 18-year difference. So the difference here is in 2019, they can get a pit stop done in 3 seconds using innovation of process, using technology. And you look 18 years prior to that, it was a 1.5-minute, 2-minute process. So having that type of mindset when looking at your balance sheet, you can go ahead and go to the next slide, is really, really important and can have a transformational effect. Okay, so the next is accounts receivable. So you think about asset quality. These are qualitative factors. Number one, remember that your customers are a critical stakeholder. At Texas Security Bank, we recognize that we have to have a strategy for adding value, not just to our shareholders, but our important stakeholders. That includes our customers, our vendors, our team members and employees, our community, and we've got to have a strategy towards adding value to each one of those. And obviously, customers are very important. Understanding the terms of sale and discounts, and understanding why our terms of sale are what they are, and whether or not to give discounts. Okay, our collection process is really, really important if we do have accounts receivable. Do we have a documented process in our collection department? Is it being followed? Okay. Here's a really important one. How is that, when you have $500,000 in accounts receivable sitting on your balance sheet, you are the bank. You are underwriting risk of whether or not you're going to be paid back. Who is responsible for extending credit, and who monitors the ongoing creditworthiness of that accounts receivable base? If a company today has $500,000 in accounts receivable, the underlying quality of those account debtors, I would guess, is not the same as it was a year ago. So there has to be an ongoing monitoring process. The other thing that can add risk to a business is the concept of concentrations. So for example, if 3 of your customers represent 80% of your overall business and your overall sales, that is a risk. And it's not a risk, it is a risk that we see often. And it's something that businesses are trying to manage themselves out of. But obviously, if you lose one of those customers, it's going to have an impact on your business. It also, from a pricing standpoint, weighs the leverage that they have over your gross margins more than if you're fully diversified. So this is something that we see oftentimes in owner-managed businesses. And then the other thing is there a strategy for improving turn days? And we'll see the impact that turn days can have on a business. And ultimately, each of these qualitative factors, when we look at components of the balance sheet, goes to, do we have accountability within our organization? Who owns that number? What people own that number maybe, and are they compensated accordingly for improvements in that number? And do those people understand the impact from a cash flow perspective, from a balance sheet perspective, that number has on the overall business? All right. Okay, inventory, similar type thing. Think asset quality, and when you think of asset quality, how quickly can that inventory be turned to cash? Manufacturers have different components of inventory: raw materials, work in process, finished goods. And the faster we can turn that raw material into finished goods, the better. Once again, there are turn days, and when we talk about turn days, going back to receivables, it's basically how quickly it takes once that's issued, that invoice is issued, to collect it, and it's on a customer by customer basis. But then there's an overall number, and the calculation is simply your accounts receivable divided by your revenue times 365. That'll give you your turn days. Once again, somebody needs to be accountable for that number. And then on inventory, same thing, but who makes the purchasing decisions and on what basis? That is real important. When we go into a business and they have a whole bunch of inventory and it's slow moving, it always comes down to an issue of accountability. And so there has to be a documented process. A lot of businesses have systems, platforms that help them make purchasing decisions based on each unit of inventory that they have, and what the lead times are, and what's the optimal quantity of that particular component based on margin and turn and that type of thing. All right. All right. Once again, velocity improves overhead absorption. What do I mean by that? Well, there's certain things within a balance sheet that turn, and certain things that may not necessarily turn. But when you look at overhead, payroll, rent, those tend to be over a period of time, say a month, a pretty fixed and static cost. And each unit of product or service that you sell, if there's increased velocity, that reduces the overhead cost per unit, right? So if I sell 500 units in a month, and I divide that into my fixed cost, that's my fixed cost per unit per month. Now, if I'm doing 1,000 units per month, you see my fixed cost per unit has gone down, right? And this is what I mean when we talk about a fully burdened basis. Understanding exactly what your cost per unit is on a fully burdened basis, and in seeing for yourself the improvement in profitability that can occur as a result of that increase in velocity we talked about is motivating. Okay, once again, I mentioned slow moving inventory. Why? That is always a question that I have, and who's responsible for that number? That's dead inventory. That could be availability on your line of credit. That could be cash. That's not earning you any money. And so we run into that a fair amount of times, and it really always just boils down to who's accountable to that. Do we have a documented process? Is that process being followed? All right. All right, double financing of inventory. Again, these are just qualitative questions associated with this particular cell on the balance sheet. What does that mean, double financing of inventory? Well, most of the time, a distributor or manufacturer buys those goods with an extension of credit. Same thing when they're selling, they're extending credit. And that is called spontaneous financing, the accounts payable that are derived from purchasing goods. And a lot of times, businesses will be provided availability on their line of credit based on an advance rate on inventory. So they're financing it on their line of credit, and they're financing it with their accounts payable. They're double leveraging that particular good. That's not necessarily a healthy sign when we see that. Okay. Next, fill rate. Real quickly, all your fill rate is a customer service metric. So if you're a distributor or manufacturer and a customer calls to buy your product, and a lot of times if you're a distributor, you have many SKUs, individual units, and if they call and you don't have it, that is a lost sale, basically. And so distributors monitor that, and they're always trying to strike that balance between minimizing the inventory they have and their fill rate, right? So somebody who has a very high fill rate and has their inventory managed very tightly, to me, it says they know what they're doing. They're running a really tight ship. Okay. All right, accounts payable, very, very critical stakeholder to the business. To me, almost as important as customers, believe it or not. Who's responsible for maintaining the vendor relationships? And if a business gets into trouble, all right, and has a tough time, that business that has very good vendor relationships, meaning they pay them on time, they treat them well, they're going to be in a much better position to access their vendors for a little relief if things ever get tight. So it's one of those things, it's not an issue till it's an issue. And so treating your vendors well is very important. Are we a good customer? We expect, you know, our customers to treat us well. Are we a good customer? That's very important. Next. All right. You can figure out what that means, but nobody likes to be treated like crap. And so vendors, what I see oftentimes with business owners is they can really not treat their vendors well. They're always trying to get that extra nickel. I get all that stuff. We're all trying to run a business, but having an approach and a mindset on, if it's not a fair deal for them, there's going to be no deal. And that's different a lot of times with business owners that I've seen. A lot of times business owners, it's a zero-sum game. They're trying to get everything they can, but there's capital that can be created by building a good relationship with your vendors. The other thing is to not be dependent on vendors. And if you have, once again, the majority of your purchases come from 2 or 3 vendors, that's a risk. And you want to look at creating dual sourcing to get the best pricing you can, and also to not put yourself in a tough situation. All right, terms of sale, are we taking discounts? Have we asked for discounts? If discounts aren't available, have we earned the right to ask for extended terms? In the case study that's coming up here, we'll talk about that a little bit. It can create cash flow. All right. All right, so we're going to talk about working capital. So we've talked about the components of that balance sheet, talked a little bit about quantitative and qualitative factor with those cells of the balance sheet. And now we're going to talk a little bit about structure. Again, what does a good balance sheet look like? So what is working capital? So having a healthy working capital position, we talked about why that's important. A lot of people think about current assets minus current liabilities. That is technically correct, but it is actually the extent to which we're able to utilize long-term capital. That means long-term debt and equity. Those are the 2 forms of long-term capital on our balance sheet. To what extent do we finance current assets with long-term capital? Okay, so this is an area where a lot of times we see business owners introducing undue risk in their balance sheet because it's not structured correctly. How does that happen? Happens a lot of time when they use short-term financing to finance long-term assets, and it reduces working capital. So I have a visual here to kind of describe this concept. You can go to, and once again, it's a cushion that creates margin in the balance sheet if there's a disruption in our operating cycle. So here you see the 2 sides of the balance sheet. On the left side, of course, we have our assets. On the right side, we have funding. And the funding is all our current liabilities plus long-term capital. It could be long-term debt, equity, sub-debt, whatever. And the light green represents all our current assets. And so when you look at it this way, you can see that what you're trying to do is finance a portion of your current assets with long-term capital, that long-term debt or equity. In the case study that we'll go through here in a minute, you'll see there may be an opportunity for this particular business to do that. Hopefully all of you got a copy when the reminder was sent out with the link to the Zoom, a case study, white paper that I wrote. And this particular presentation is directly from that white paper. So there's a lot of additional backdrop to the story and everything. If you did read that and you're going through this presentation, some of this will resonate more And if you haven't, but you've got that white paper, after we go through this, if you have a chance to flip through it, some of these things will possibly make more sense. Okay? All right, Tiger Manufacturing. All right, some of their metrics right now, we'll look at their balance sheet here in a second. Their accounts receivable turns are 59 days. Their inventory turns are 70 days. And they have always taken really good care of their vendors, 32 days. Their terms of sale for most of their businesses are 30 days, and yet they're at 59 days. What is going on there? And their inventory turns are 70 days. Inventory turns are calculated similarly. It's usually your inventory divided by your cost of goods sold or your purchases times 365. So that's their metrics that we're going to focus on. If we look at their balance sheet next. All right, so let's look at this balance sheet a little bit and see what we can pick up. We've got a little summary box there on the bottom right-hand corner. You can see their leverage is crazy. It's 180 to 1, basically. Now, we run into this a lot of times. Again, you have to think long-term about your business. Are you trying to hand it off to you have a succession plan? You want to leave it in really good condition when you do? Are you trying to sell your business and optimize the value? And a lot of times, maybe a company is an S corporation, so they don't retain a lot of equity. Well, that affects the risk of the business, and it's a kind of a cost of doing business in my mind. The other thing is a lot of business owners live out of their business, so they don't recognize a lot of profit, and so they never build up their equity account, which is long-term capital within the business. And so we run into oftentimes these balance sheets that are upside down because of certain advice that they've gotten from their CPA or something, which is probably good advice in some regard in terms of minimizing capital, but is it good advice in terms of whatever your long-term plans are in the business? You can see they have a very thin current working capital position. The current ratio is barely over 1. They got $10,000 in the bank, and they're maxed out on their $750,000 line of credit. Okay, so if they run into one of the disruptions in the business cycle that we talked about, or a shutdown like we're in right now, it could be a headshot to this business. So if you read the case study, what you'll see is the son who takes over, is beginning to take over the reins of the business. He realizes that they're seeing a slowdown in the economy 3 years out, and he really knows that he needs to get their house in order. Okay, let's go to the next year. Okay, so in year 2, they put in place some things, some accountability that we talked about, and they went to their particular trade organization. Where can you get benchmarking? You can get it from RMA. A lot of time trade organizations have data. Your banker should have data that'll give you a good idea on what is the medium for each one of these metrics, what's the top quartile for each one of these metrics. Once again, they're just reference points. And so they put in a documented process for accounts receivable. They put in place expectations with their customers. They reminded their customers of when payments are due. When somebody goes past due, there's a friendly reminder letter that goes out. And so there's a process there. They started putting in place a documented process regarding purchasing. And they started to incent their warehouse managers for improving turn days. And because they had such a great relationship with their vendor over the years, they went to those, and most of their vendors didn't provide discounts. They went to those vendors and said, "Hey, look, I've been buying from you for the last 10 years. Is there a way that we could get instead of 30-day terms, maybe 40 or 45-day terms?" And some of those vendors agreed to it. Okay, so they built up capital over the years by being a good customer and they went to them and were able to get a little longer terms. Okay, so let's see what impact that had in the balance sheet on year 2. Okay, you can see a little bit of improvement. Current ratio improved. Their liquidity improved significantly. You can see they paid down their line of credit a little bit. They have over $200,000 in cash. Obviously, they could sweep that cash to the balance sheet, improve leverage even more. But this was definitely a healthy step in the right direction just by incorporating processes in certain departments within the business. Okay, let's see what year 3 looks like. Okay, so they reduced accounts receivable even further to 41 days, improved inventory significantly, and were able to pick up, persuade a couple of vendors to give them extended terms. And the resulting balance sheet is much improved, as you'll see. Now, one of the things we did, each of you received the white paper, and it has both the income statement and balance sheet. And we tried to keep the income statement pretty static and kind of hold it flat. And so the improvements you see in the balance sheet are primarily the result of just the processes in these components that we talked about, not necessarily an improvement in profitability. Okay, next. All right, so the balance sheet now, you've got a healthy current ratio of 150. Leverage, quite honestly, for this type of business is still a little bit high. If you go back and look at the interest that they've paid, they've brought their interest cost way down because they've paid down their line of credit. And so as we mentioned, the cost of capital has improved greatly. They're in a much healthier position in case of an unforeseen event or an opportunity that they want to take care of. And then we look at the final year here in year 4. I'm not saying this takes 4 years to do, but this is something that should be talked about in strategic planning in a business. If the balance sheet is out of whack, what is our strategy for improving it? We go to year 4. Same thing, really starting to get receivables into shape. Inventory has improved significantly. Accounts payable is up to 38 days. Even without the extension of the accounts payable, we would see significant improvement in the balance sheet. All right, let's look at their balance sheet now. Very healthy current ratio. 183 is great. Healthy debt to leverage, debt to tangible net worth, excuse me. The other thing to point out is liquidity has really, really improved. They pretty much have full availability on their line of credit. So liquidity, if you remember, 4 years ago was $10,000 in cash. Now it's 700 and whatever, 32,000. So they've done an excellent job, and this helps the business owner sleep much better at night than the way things looked 4 years ago. Okay, so if we kind of look at just the trend here on what we did, you see significant improvement in liquidity, significant improvement in working capital. The leverage came way down, all a result of realizing that there were both quantitative and qualitative considerations on each of the components of their balance sheet. Now, one of the things that we didn't talk about from a qualitative standpoint on the balance sheet is other things like building and equipment. All right, how can there be qualitative components to building and equipment? Again, when I look at a balance sheet and I see the building and equipment, I know that that building equipment was recorded on that balance sheet at cost. But I don't have an idea on what the appraised value of that building of equipment is. And I can't tell from the balance sheet on whether or not those very, very important components of the balance sheet are well taken care of. So those are qualitative factors as well. Is our building and equipment well maintained? Are there documented maintenance procedures? Who is accountable for maintenance? Do we know the value of the building and equipment? Do we know our equipment utilization rate? I see this a lot of time. I walk through a printing operation and they've got all this equipment, but only half of it's being utilized, right? And so the utilization rate, what is the amount of time in a working day that that equipment is operational and producing revenue for the business? If you have dead assets on your balance sheet, could they be deployed in another component of the balance sheet that would help earn more money? We talked about this, for example, with dead inventory, but I see this with equipment as well. And I can walk through a business owner's building and pretty quickly surmise whether or not it's well taken care of. And if, from a banker's standpoint, if that building is going to be something that we're going to have as collateral on a mortgage or something like that, that's an important thing. So that is building a healthy balance sheet. Again, I know it probably doesn't apply to all our participants today, maybe not at this point, maybe in the future, but there are concepts that we talked about here that apply to every business. And hopefully when you look at your balance sheet going forward, you'll think about some of these things on how you can improve your balance sheet in order to take advantage of opportunities that might be out there, and also protect you in the event of a downside. So with that, we can take questions.
All right, and I want to remind everybody, if you have any questions, please submit those in the chat feature, and then we can bring those up to Craig to answer. So Craig, normally I saw that you do these presentations for the TSB Academy. Can you give us more information on that?
Yeah, so I think you guys probably have a pretty good idea the history of the bank, and Sean alluded to it in the beginning. Our purpose and why this bank was started was I realized over the course of my banking career how important businesses like yours are to our community, our civilization, quite frankly, and our standard of living. When you look at businesses that are less than 100 employees, businesses less than 100 employees in our economy create about 75 to 80% of the net job growth in this country. The other thing that we realize is that the average business owner, the person who's willing to take advantage of the opportunity of free enterprise that we have in this country, if they have a college degree, it's not in one of the business disciplines. And so we were really inspired by the stories we've heard of how businesses got started, in the amount of sacrifice and hard work and risk that had to be undertaken in order to do that. And so we realized that there was a lot of business owners that played such a vital role in our local economies, in national economy for that matter, that from my standpoint, were somewhat underappreciated. And that's where the idea for the bank came, that we were going to do everything we could, provide every bit of resources we could, primarily through education, in order to enable these business owners to succeed, to grow, to hire more people. The other thing that a lot of people don't understand is that these businesses less than 100 employees, they pay the majority of the federal income tax in this country. When you look at the property tax they pay, the federal income tax they pay, the payroll taxes that they pay, they are without a doubt, businesses, you people, businesses less than 100 employees, are the strong horse that pulls the whole cart in our economy. And so we provide TSB Academy, which is a one-year program, 50 hours of class time, subject matter experts, both external and internal, talking about everything that in a business, from the very fundamental to the very technical, like cybersecurity and search engine optimization and branding and marketing, and accounting 1 and accounting 2, and how, as we talked about a little bit here today, how to fund a business properly without adding additional risk to your balance sheet. And then we have the speaker series. We participate in the Bold Speaker Series in Garland, and then we also have a speaker series in Dallas. What I would encourage you guys to do, if you're not connected to us on LinkedIn, I'd strongly encourage you to do that. And our speaker series are somewhat a la carte training. And so it's not a one-year commitment. And as you see topics that may be germane to your business, or that you or your key players within your business might benefit from, it could be HR, for example, or it could be technology, or it could be legal, to spend an hour and jump on a Zoom, or when we get back to normal, show up to a lunch and learn and for free, and pick up very, very valuable information that could help you succeed.
Thank you for that. We do have one question here. We just got another one. Okay, so the first one. Can you more fully explain inventory cost per unit on a fully burdened basis for a company that has 1,000 of products they sell?
I saw that this came from my good friend Jeff Kilpatrick at EGW. And the idea here is really understanding each of your units, and obviously there's a cost for each of your units and how much you sell each of those units for. And there's different ways, and you can do it in a way that maybe is unique to your business, of being able to look at other costs outside the cost of that product. In manufacturing, you get this a lot, because cost of goods sold in a manufacturing operation oftentimes captures direct manufacturing costs like labor, but it'll also have an allocation for manufacturing overhead within it. And what all manufacturers understand is that the more velocity they put through that operation, the more they're able to spread those fixed overhead costs over the unit. The same thing can be done for a distributor, in realizing that velocity reduces my cost per unit, and reducing my cost per unit increases my margin per unit. And so that's the concept there. So even if it's corporate overhead that you're allocating as a distributor, SG&A over those units, understanding that the more units that the more velocity that we can put in that organization, the less cost of overhead per unit. That's the concept. I don't know if that answered.
Oh, we have one other question. Can you talk about the expansion of AP days and the relationship effects with vendors?
Yeah. So again, you want to be a good customer. And in the particular case study we did, this particular client had built up a lot of relationship capital, and had earned the right to at least either ask for discounts for early payment, or in lieu of discounts for early payment, can we extend our accounts payable days? Again, you have to strike that balance on wanting a win-win with your relationships, whether they're vendors or customers. And so understanding the concept of how cash flow is created within an organization, that if we can collect our receivables faster and pay out our accounts payable slower without damaging the relationship with those vendors, that's kind of the equilibrium that looking for. So I think if it were me, as a business owner, you kind of have to earn that right and add that, that's why I was talking about creating value in the relationship. If you treat your vendors poorly and you go to them and say, hey, I'd like to increase my terms from 30 days, doing 30 days to doing 45 days, you're probably not going to get it. If you're difficult to deal with, you're always trying to, penny pinch and everything like that. I've done this long enough and worked with enough business owners to realize the ones that I found that are the most successful are the ones that have the mindset is it's got to be good for you, it's got to be good for me, and if it's not good for you, no deal. And you may not get every penny every time, but in the long run, you're going to develop a reputation with your customers and your vendors of being a solid person. And if you need help, then you built up some capital to be able to earn the right to ask for help. And so it's a balance, and it's really kind of being deliberate on adding value to those stakeholders, and having a strategy to add value to those stakeholders, and then they're going to be there when you need them. And if you're trying to improve your balance sheet by increasing cash flow, and you go to your top vendors that you've treated well and ask for, hey, can we change from 30 to 35 days or 35 to 40 days, they're going to be more receptive is the point.
We had another question come in. It says, what are some typical discounts that you see?
It depends on industry. Usually one very common is if you pay within 10 days, you get a 2% discount. If you look at in there, and it can be a negotiated deal. And again, the first thing to do is ask. And usually, if you look at the cost of not taking the discount, you do the math on it. Usually, the cost of not taking the discount is like 18% oftentimes. And you look at the cost on your line of credit. In our case study, I think it was 5.5% on their line of credit, which I wish we could still get 5.5%. But anyway, so it's always, if I go in and visiting a company and we're talking about their vendors and whether or not their vendors provide discounts, and they haven't asked their vendors, that's a red flag. And if they're not taking the discounts, that's a red flag too, because usually the opportunity cost of taking the discounts is well worth it.
All right, well, those are all the questions I see so far in the chat. Again, thank you so much, Craig, for your presentation. That was some valuable information. We are recording this, so everybody will receive the link to the recording and the presentation. And if you didn't get a chance to see the attachment from yesterday's email, I will also attach that, which was the case study that was based on the presentation. Like I said, again, thank you, Craig, for your presentation, and thank you to our sponsors and our partners, Texas Security Bank. Thank you, everybody, for joining us this morning. I just have a few reminders. Next Monday, August 31st at 11:30, we have our Spark on the Go event. Dr. Lopez will present the state of the district. Also, our 36th annual golf tournament is on September 18th. We have many safe opportunities to market your business on the golf course, so visit garlandchamber.com for more information. And this concludes your event. So everybody have a great day. Thank you for joining us.